A blue-chip asset manager just watched a private loan go from all good to worthless. Not markdown. Not a small haircut. Zero. It happened fast. And it exposed a blind spot most people still ignore. When returns look calm for years, risk doesn't disappear, it hides. The write-down wasn't in some meme stock or a penny auntie scheme. It was a BlackRock loan to a home improvement roll-up that a month earlier was still carried at par. Then bankruptcy hit and the value collapsed to nothing. If that can happen in a portfolio that's marketed as steady and sophisticated, what else is being smoothed over by models and optimism? Private credit promised strong yields without the drama of public markets, less mark-to-market pain, fewer daily price swings. But the lack of daily pricing can be a feature and a bug. When borrowers stumble, models often lag reality. That's why this moment matters. BlackRock is marked to zero is a flashing indicator for a market that ballooned on easy money and investor hunger for income. It's not the whole market falling apart. It is something more subtle and, for many, more dangerous. The reminder that low volatility can be an illusion created by infrequent valuation and generous assumptions. That illusion is cracking in other corners too. BlackRock private credit. CLO, the kind of vehicle built to spread risk, kept failing key over-collateralization tests for months, enough to trigger S&P downgrades on its riskiest slices. That isn't just a footnote for bond geeks. It's a sign that some underlying loans aren't performing as expected, and that cash flows meant to protect the structure are under stress. CLO mechanics are boring until they aren't, and failed OC tests tells you the safety buffers are being eaten away. You don't need to be a credit analyst to get the point. When protections start flashing red, the cushion that made everyone feel safe gets thinner. Zoom out, and the macro backdrop explains a lot. Cheap money hid weak underwriting. For years, companies could refinance before trouble showed up. Then rates went higher and stayed higher for longer than many expected. Even with 2 cuts later in the year, the Fed spent most of 2025 sounding cautious. Powell warned repeatedly about inflation's persistence, tariff-driven price pressures, and the risk of moving too fast on cuts. Caution from the top means financing doesn't magically go back to 2021 conditions. When the cost of money rises and stays elevated, marginal borrowers feel it first. Cash interest outlays jump. Maturities that once looked extendable become hard. Payments slip, confidence fades, and lenders who were patient at 0% suddenly get clinical at 5%. That's why debt cycles bite late. The stress doesn't show up all at once. It seeps in, a borrower misses a covenant. A CLO test fails, a single loan goes to zero. The headlines ping between everything fine and the next 2008, but reality sits in the middle. According to Fitch, the base case for 2025 was mid-single-digit defaults in leveraged loans and high-yield bonds, ugly enough to hurt, not catastrophic enough to justify doomsday metaphors. Europe, meanwhile, showed its own cracks, with giants like Thames Water and Altus shaping a default path that could reach post-2008 highs for the region as high-yield market. Nothing collapses in straight lines, but pressure builds. And people with long memories are noticing. Jeffrey Gundlach called a lot of what's happening garbage lending, pointing straight at the private credit, the boom as the likely spark for the next big crisis. He's not the only one seeing the risks. Insiders have whispered the same thing for a while. Too much money, chasing too few deals with terms that assume a benign future. It is easy to pile into safe-ish paper when the spreadsheet says defaults stay low and recoveries stay high. It's harder when revenues stall, costs rise, and the borrower's assets don't fetch what the pitch deck promised. The critique isn't that all private credit is rotten. It's that pockets of it were built on optimism priced as certainty. BlackRock, for its part, is telling investors not to overreact. They've described recent blowups as idiosyncratic specific sectors. Specific borrowers, sometimes specific instances of misbehavior, not a system-wide infection. That message resonates because it's partly true. Most markets don't break everywhere at once. Stress starts as isolated fires. The question isn't whether every loan is in trouble. It's whether those fires spread in a world where refinancing is harder, growth is slower, and investors no longer believe their assets are bulletproof. Even if the idiosyncratic line holds, a series of one-offs can add up to a mood shift. When confidence is the product, narratives matter. So why are Bitcoiners watching all this so closely? Because this is a textbook reminder of what credit risk is. The risk your money is someone else's liability. Private loans can reprice from par to dust. Spreads can look thin until they snap. Structures can pass every test right up to the month they don't. Bitcoin, love it or hate it, sits outside that game. It isn't a promise to pay. It isn't a claim on cash flow. It's property. That's Michael Saylor's core point when he calls money economic energy. You either hold a money-like asset that can be diluted or seized or devalued, or you hold something with no counterparty. In a credit-heavy system, those differences matter most when things break. Jeff Booth approaches it from another angle. Technology wants to make things cheaper over time, but our debt-based system fights that natural deflation by pushing credit growth. When you force the price level up with more money and more debt, you set the stage for periodic resets. Sometimes the reset is a gentle, soft landing. Sometimes it's a string of idiosyncratic messes that turns into a trend. In that world, an asset that aligns with deflationary tech and docin, rely on someone else's solvency, isn't a magic wand, is simply orthogonal to the failure mode of credit. Policy shifted this year too, and that's not a footnote. The White House created a strategic Bitcoin reserve, directing the government to hold seized BTC rather than dump it at auction and to treat it as a strategic asset. That wasn't Washington buying Bitcoin with new budget dollars. It was Washington saying, "We will keep what we already control." That move changed the conversation in boardrooms and on trading desks. If the U.S. government treats Bitcoin like a strategic commodity, it legitimizes what corporate treasurers and institutions have been inching toward for years, a small, durable allocation to a bearer asset that doesn't depend on anyone else's promise. None of that means Bitcoin is painless. It's volatile. It can drop hard. It can go sideways long enough to shake out the impatient. But the relevant comparison this cycle isn't day-to-day swings. It's the structural risk you carry when your safe income is a loan that might be marked by a model until the model catches up to reality. That's why the old critique, but Bitcoin has no yield, misses the point. Yield is the fee you're paid to bear someone else's risk. When that risk is mispriced, the yield is bait. The crash is the bill. It's worth puncturing some myths quickly. Bitcoin only benefits the rich, misunderstands how compounding and scarcity work. Anyone who saves in a currency that loses purchasing power year after year pays a hidden tax. An asset with hard-capped supply, portable custody, and global liquidity gives small savers a chance to opt out of that tax, especially in countries where the banking system is either predatory or fragile. Bitcoin is just speculation, ignores the policy shift we just mentioned and the involvement of public companies, sovereigns, and infrastructure-grade custodians. Speculative assets don't get written into executive orders. Bitcoin can be banned, is always lurking. But the direction of travel in the U.S. this year went the other way. Clarify, consolidate, and in some cases, integrate. Back to private credit for a second. The uncomfortable truth is that most investors don't read trustee reports or ratings actions. They see a line on their statement that barely moves and assume low risk. They look at a 9% yield and think safe income because the price chart doesn't do anything dramatic. But stability without transparency isn't safety. It's a delayed reveal. When OC tests fail, when fee waivers appear, when management teams start using words like idiosyncratic, that's the universe tapping you on the shoulder. It's saying, you are the creditor. Your income stream depends on someone else not missing a payment and someone else's assets holding value. That's fine until it isn't. The takeaway isn't to sprint to extremes. It's to recognize the portfolio implications. If you're reaching for yield in opaque structures at the end of a tightening cycle, Ask yourself whether you're being paid enough for the tail risks. If you're assuming policy will rescue every shaky borrower, reread the Fed's guidance cautious, data-dependent, and not in a rush to flood the system. If you're counting on narratives to carry you, remember how quickly narrative flips when someone marks a loan to zero. And if you're still debating whether Bitcoin is real, watch who's holding it now. Companies with auditors, governments with custody mandates, institutions building regulated wrappers. The center of gravity has shifted. This isn't a doomsday message. It's a map. Credit cycles tighten. Some loans fail. Ratings follow. The system absorbs losses, reprices risk, and moves on. Meanwhile, the set of assets that don't rely on someone else's promise becomes more interesting, not because they are perfect, but because they are different. That difference is the hedge. It's not about making a quick trade. It is about deciding where your core savings should live so a single borrower as failure can't take them down with it. There's also a political economy layer here. When the government keeps seized Bitcoin in a digital Fort Knox, it signals to agencies, banks, and large allocators that custody, accounting, and risk frameworks need to be standardized. That institutional plumbing work is boring, but it's the foundation for broader adoption. It's also a quiet answer to the ban it crowd. You don't build procedures to hold and audit an asset you plan to outlaw. You build them because you expect it to matter. So where does this leave the everyday investor? Start with first principles. If something is offering high yield with low apparent risk and minimal transparency, be skeptical. Ask how it's valued, how often, and by whom. Look for stress indicators, test failures, fee waivers, redemption gates. Consider the macro. Higher for longer turned into cautious cuts with a lot of hedging in the Fed's language. That's not a green light to lever up. It's an environment where selection, liquidity, and duration management matter. And consider holding some portion of your savings in an asset whose risk isn't someone else's solvency. Even a small allocation can change the profile of your portfolio, not by chasing yield, but by removing a failure path. If this sounds like a pitch for Bitcoin, it's not. It's a pitch for clarity, for understanding what you actually own, for asking whether your income is really a premium for risks you haven't fully priced. The lesson of a loan going to zero overnight isn't that every loan will. It is that the model that made that loan feel safe didn't catch up until it was too late. The lesson of a CLO failing tests for months isn't that the system is broken. It's that the warning lights were on while investors kept their eyes on the headline yield. And the lesson of a government building a strategic reserve, IS&T, that prices will only go up. It's that the asset has crossed a line in perception from curiosity to component. If you're still here, you care about making better choices with your money. Here's how you can turn this into action. First, audit your yield. Identify where you're the creditor and how quickly your positions could reprice if borrowers stumble. Second, decide what portion of your savings should live outside the liability chain. That might be Bitcoin. It might be a mix of other scarce assets. Third, stop treating policy as an afterthought. The Fed's path and the White House's stance are now part of the same story. They shape liquidity, incentives, and the cultural permission structure for institutions to act. And if you want more deep dive breakdowns like this, without the hype and without the jargon, hit subscribe so you don't miss life-changing financial context when it actually matters. Give this video a like if it helped you see the landscape more clearly. Share it with someone who still thinks every 9% yield is safe income. And tell me in the comments where you stand. Is private credit a smart opportunity after a healthy repricing? Or are we just at the start of a longer, messier unwind? Your take might help someone else see the other side of the trade.